Clive, thank you very much for joining us today. How are things in Geneva?
Well, James, thank you very much for having me on your channel. It's been about 20 degrees centigrade, torrential rain and lightning. I nearly got struck by lightning I'll say it's about 300 yards away, 300 meters away from me. But it's the closest I've ever come to lightning. It was a double flash, which I've never seen before. Usually lightning is a single flash, but it went, flash, gap, flash.
Well, I'm glad to hear you're okay. And so you live in Geneva. You've been there for many years now. What brought you to Geneva from the UK?
Well, I didn't go directly from the UK. I was working in the UK in wealth management, and I, at some point, got offered a job out in the Cayman Islands in the West Indies, the British West Indies. So I worked there for a few years, but back then they were quite limited on the work permits. You were allowed to go for a maximum of 3 years. So as my 3 years was more or less up, I applied for a job with my former employer, but not in the same country in the UK. I applied in, well, actually they invited me. They had two jobs available. One was in Geneva, and the other one was in Hong Kong. I could take my pick. I chose Geneva. I think with hindsight, it would have been more fun to go to Hong Kong as a young man. But anyway, Geneva was what it was, and here I am still here 40 years later. Well, now I've been retired now for 3 years. I worked in wealth management up until the age of 65, and then I retired. And in my retirement, I'm still giving out lots of help to people to help them manage their residency, their tax, their wealth, their investments. But I'm not getting paid for any of this. I mean, I don't want to be paid. So as of today, I don't do anything for money. I don't have any subscription services. I don't charge anybody anything for anything, but I'm more than happy to help people if they want to understand if they're on the correct track from a financial point of view. For example, retirement planning, that sort of thing.
Well, that's why I want to speak with you today to get your thoughts on what's happening in the global markets. And before we step away from Switzerland, I want to mention that I was there last year. I flew into Geneva and I flew out of Zurich, and I probably hit a half a dozen places in between. The scenery is just amazing. I just can't get over how beautiful that place is. But the one place that really stood out to me was Zermatt and the Matterhorn. What are some of your favorite places in Switzerland?
Well, we were at Zermatt twice this year, once over Christmas, and it's a very, very beautiful mountain village. Obviously, a lot of luxury shops, very, very expensive shops, like Armani and Louis Vuitton and Hermes and so on. And of course, there are some very expensive hotels there, but it's not expensive for everybody. A lot of people, like we stayed in a normal apartment where you pay normal rent. You may pay a little bit more because it's Zermatt. But yeah, it's a great place, and the skiing is fantastic for those who enjoy skiing. I didn't do it, but my 8-year-old, he was 7 at the time, was out with the ski instructors up in the mountains, so he enjoyed that.
Yeah, I don't waste my time going to any of those high-end retail outlets, but I just did lots of hiking there, and it was just I would highly recommend it to anybody who is watching this. And if anybody has any great ideas on where else I should be going in Switzerland or any places I should be going to hike, let me know in the show notes below. So why don't we move on?
On the screen behind me, you see a picture of Lauterbrunnen, which is very near to Interlaken, which has got lots of mountain villages around it, one of which is Lauterbrunnen. You see the waterfalls and the Green Valley, a beautiful place to go, especially if you like hiking in the summer.
Oh, that's good. I will be sure to check that place out. So why don't we move on now? And I want to get your views on what's happening within the global markets. And I'm sure you would agree with me when I say we're living through some very unusual times right now. And this is one of the reasons why I love the financial markets, because you get this confluence of politics and economics, and it can create a lot of volatility. And you can make a lot of money and you can lose a lot of money. Hopefully you make money. But so I want to get your views on the financial markets. And I want to begin with the US. We've seen a lot of volatility with the S&P here in the last few months. What are your views on the US economy, and do you have any concerns?
Well, we've seen a lot of flip-flopping from a political point of view, and obviously the market has reacted to that. One day it looks like it's the end of the world and the markets are going to go down and we're going to go into a bear market, which would be minus 20%. The next day it's up 3 or 4% and roaring away. Now it looks like we might be heading to the all-time highs again. I don't think anybody can call the shots. I mean, I thought we were going to have when we bounced. I thought, okay, this is going to be a dead cat bounce, and I started raising a bit of cash on the rally. But I've subsequently changed my mind and started going back in the market. The funny thing about markets is they don't always do what's written on the tin according to the economics books. I can take 1994 through to 1999 as a good example of that. 1994 was a period where stocks seemed to be very overvalued. Interest rates were rising. They should have gone down. Yet we had a 7-year rally, one of the greatest rallies in stocks in all of history, at a time when that shouldn't have happened. And then that, of course, culminated in the dot-com bubble as we got towards the end of the 1990s and into the year 2000. And of course, at some point, it took on a sort of surrealism because this became absolutely unbelievable. We had companies coming out like mushrooms in the night with no proper business plan, or what didn't seem to be a proper business plan, and in many cases, no sales and no profits. It was just, a shell with the word .com at the end, and people were buying these companies. But if we go back some years before that, the mania still existed in a certain sense. Companies would come out with, "We now have an email address," and people say, "Wow, they've got an email address, sales at whatever it is .com," and simply getting an email address could boost your share price. But in 1994, technology stocks were risky stocks, so they were cheaper than non-risky stocks. Now, of course, and by the end of the dot-com bubble, and as of now, technology stocks are much more expensive. But that's the funny thing about markets. Even inside the sectors, the relative value or perceived value can change all the time. You can go through periods when something which is very much out of favor suddenly gradually becomes in favor, and vice versa. So where do I think it's going? I wish I could tell you the answer to that one. I don't know, and I think I personally, and I think everybody should be prepared mentally to withstand either a melt up in stock prices or a meltdown. And if I could tell you which one it is, I'd love to do that. But I do think the tech side is rather overvalued, and it's not a place where I'd be putting my money now, because if you're doing that, you're running with the crowd. Every portfolio manager on the planet is buying ETFs which are invested in the S&P 500, and the S&P 500 is 35% the top 7 stocks. And at the top end, it's very weighted on the overpriced stocks generally. So whilst some investment managers will say, "I'm not buying Amazon, Tesla, Microsoft, Apple, whatever it is, because I think the multiples are too high," they are, in fact, buying those stocks through the back door anyway, when they buy the ETFs for their clients.
Yes, and
So you can,
recap what the S&P has done here in the last few months. It peaked at 6,100 in the month of February, went all the way down to 4,800 in the month of April. Here we are in June, and we're right back to where we started. Now we're at 6,000 again on the S&P, and I'm one of these people that have been totally surprised by this move. I thought for sure we were going to break down when we went down to 4,800, and it was going to keep going, and I am
I
surprised now.
I shared your view. But it looks like the money is there. I think there's one thing which is changing a little bit, and that is the perception of how soon the Federal Reserve is going to be forced to pivot. Um, it looks more and more likely to me. Now, what does pivot mean? It basically means they change from what's called quantitative tightening to quantitative easing, and I'll explain for the benefit of your viewers what those mean. So as if we a little bit of a history lesson, if we step back to 2008, when we had the global financial crisis and all the banks were going to go bust, the Federal Reserve stepped in and lent huge amounts of money to the government so the government could help bail out all the banks. And surprisingly, there was very little effect on inflation. So the market was flooded with this money. So what was happening? The Federal Reserve was printing money to buy government bonds. And they filled their boots with these government bonds. But as they did so, their balance sheet got bigger because they had more government bonds, their asset, they had more money, which they printed, electronic money, of course, which is their liability. And then we went into the COVID pandemic and they repeated the trick. So the government could send everybody checks to keep them on furlough pay or whatever it was. And once again, printed huge quantities of money, expanded the balance sheet. That's quantitative easing. And the size of the Federal Reserve's balance sheet, for example, got much larger at that time. And there was more money in the system because the government was borrowing that money, because the Federal Reserve was buying the government bonds. The government was borrowing the money and spending it and dishing it out to all and sundry. So everybody else was getting richer while the government got poorer. Then the Federal Reserve started to raise interest rates, and it went from effectively 0%, where it had been for many, many years, up to, I think it was 5.5 or yeah, I think it was 5.5%. And the Federal Reserve went into what's called quantitative tightening mode, the opposite of quantitative easing, except their efforts to do so were very feeble. So whilst they'd expanded the size of their balance sheet very, very fast, shrinking it back has been extremely slow, and they've barely made any change in it. Of course, they have made a change. They've done a bit of quantitative tightening. They've shrunk the balance sheet a little bit. But if you can imagine that expanding the balance sheet like 200%, they've gone backwards maybe 10 or 15%. It's hardly anything at all. And those are just numbers I made up in my head. They're not actual numbers, but the balance sheet as of today is many, many times larger than it was pre-pandemic and many times larger than it was pre-global financial crisis. So right now they're officially in quantitative tightening mode, which means that they're trying to keep the money supply in check. And at the same time, the US government has a debt ceiling. That debt ceiling came into force, as it does frequently every few years, came into force on the 2nd of January this year. That means the US government may not go into the market and borrow any more money. Of course, as they have bonds maturing, they can borrow new money to repay the existing debt, but the interest on that debt and all their extra expenditure over what they're collecting in taxes has to be funded from somewhere else without borrowing. So what they have done now is what's called the emergency measures. And the emergency measures basically mean two things. One, they've been running down their cash balance, which was before the debt ceiling was hit, something like 800 million. And secondly, they're suspending payments into the government pension fund plans. And once they raise the debt ceiling, maybe in July or August this year, if they raise it, we assume they will make the pension plans whole again. They'll refund the pension plans what they didn't put in, plus the interest the pension plan would have earned. But if we get past July or August and the debt ceiling is not raised, there is a risk of default. It's not a very high risk. The market is pricing that risk at about 0.79%, slightly less than 1%, so less than a 1 in 100 chance of default. But nevertheless, it's not a zero chance. But why am I talking about this in connection with quantitative easing? Well, come July or August, they're going to have to refill the Treasury's coffers. And to do that, they're going to have to borrow something like $1 trillion in the marketplace. Now, they won't borrow it on one day, but over a very short time span, they're going to have to raise at least $1 trillion to perhaps refill the coffers, repay the pension plans, what they owe, and of course to fund the ongoing deficit, which is when the government is spending more than it collects in taxes on social security, wars, and God knows what else. So what's going to happen in August when they suddenly have to borrow this huge amount of money in an environment where more and more nations are starting to get indigestion about holding more and more government bonds? Because we mustn't forget the historically, and this is going to continue, the amount of government borrowing has been increasing at a faster pace than the national income, the gross domestic product, which means that the borrowing is, it's like in a household where your salary is going up by 3% a year, but your debt is going up by 7 or 8% a year. It can't go on forever because sooner or later, someone's going to come knocking on your door saying, we're going to cut your credit. And I think there is a danger we're going to get to that situation at some point in the next, I think in the next 12 months. And it might happen in July or August when the government has to raise this huge amount of money once they've raised the debt ceiling.
Okay, so let me ask you about the bond market and the yields on the 10-year. We've seen a lot of volatility this year, just like we have in the S&P. In January, the yield on the 10-year was 4%. It got as high as 4.80 in later in the year. Right now, it's vacillating around 4.40, 4.50. Jamie Dimon recently did an interview and he said that there are cracks forming in the bond market. He's very concerned about what's happening there. Now, he doesn't know if the bond market's going to break in 6 months or 6 years, but he is concerned about what's happening there. What it sounds like you also have a lot of concerns. And if I'm hearing you right, you think there's a high risk or high probability of interest rates going a lot higher. Is that correct?
That's right. I mean, Jamie Dimon referred to the worsening fiscal situation of the United States. He said it's a big deal, it's a real problem, and he said bond markets are going to have a tough time. And I think he's hit the nail on the head. Of course, he has a better inside track than I have. I'm just looking at what I can see. He probably sees a lot more than I see. And what I see is the government's going to have to raise a lot of money. And I don't know where they're going to get it from because, a traditional buyer of US treasuries would be Japan. But we'll talk about that in a bit. But let's just say that Japan has got its own problems. And rather than buying American government bonds, if they're going to buy any bonds, they should be buying their own because interest rates there are starting to spiral out of control. But yes, I think what we've seen is several cuts in the interest rate in the USA. They've cut the rate from 5.25, 5.5 down to where are we now? We're about I think 4.25. So that we're down at 1% in interest rates on the short-term end, the Fed funds rate, and at the same time, the yields on these long-dated bonds are standing, especially if you look at the 30-year, standing as close as makes no difference to the highest interest rate in perhaps 20 or 30 years. So longer term yields appear to be rising while shorter term yields appear to be going down. Why is that happening? Because people say there is no real plan to rein in these budget deficits. This debt is going to grow faster than GDP, faster than the economy, and there's some other things going on which make that even more unsustainable. One of them is the fact that the maturing debt, which was all borrowed over the last decade since the global financial, well, 13, 15, 2008, yeah, 17 years, over the last 17 years, I suppose. All of that was borrowed at very low rates of interest. It's coming to maturity. And when that debt has to be rolled over into new debt, that new debt has these much higher rates of interest for, let's say, 4 point something at the moment, which means the new debt is costing the government a lot more. Now, the Congressional Budget Office have done their sums using an assumed rate of interest of 2.8% going up to 3.3%, which is an assumed rate for the next decade. But realistically speaking, the interest rate is probably going to be somewhat higher than that. So their numbers are going to be, which show this GDP, this debt to GDP ratio rising. It's probably going to rise faster than they expect unless some miracle happens. But what they haven't done or hadn't done until last week or so, was a revised calculation based on the possibility that the big, beautiful tax bill will go through the Senate, the pass, and become law. Because if that becomes law, it means the tax cuts which were, or the tax breaks which existed, some of the tax breaks which did exist, would have ceased to exist at the end of this year. But now those tax breaks are going to be extended for many years, meaning that the deficit is going to be considerably larger than they have been budgeting for. So there's that going on. And I think there's an awful lot of negatives for the US bond market, which means what does that mean to the average investor? This comes back to why we go back to quantitative easing again. Sooner or later, those interest rates are going to hit an unacceptable level. Now, I can't tell you what that unacceptable level is. You can guess, everyone's guessing it's somewhere above 5 and probably below 6. And if you look at the 30-year bond, where as near as makes a difference, 5% is 4.9 something now. So let's say we go to 5.5%, and the Treasury, which is deeming that to be more and more unacceptable because it's costing them more and more to roll over debt. And so you could expect them to start to lean on the Federal Reserve. Now, obviously, the Federal Reserve is supposed to be independent, but there's many examples where they've been told what to do and they've obeyed willingly, just as they did in the COVID pandemic, just as they did in the global financial crisis, and as they had done in some occasions in years gone by. So I expect the Federal Reserve will be invited to start printing money and support the government bond market by buying bonds to stop the yields going any higher. Now, that means that the quantitative easing is coming, the level of money in the system starts to rise, the balance sheet of the Federal Reserve starts to rise, and the wealth of the population starts to rise because the government is spending money, getting poorer, someone else gets richer. So people are saying, if that's coming, there's going to be money flowing into other things, because they're not going to be flowing into treasuries, because the Federal Reserve will be buying all those treasuries. So people are starting to front run it, and perhaps they're buying, I think they're looking at equities, I think they're looking at gold, they're looking at Bitcoin, and of course some people just say, well, if I can get a property, obviously we talk about how good or bad properties are, but there are properties that people want to buy because they see that as another way of protecting their wealth.
Interesting points. So you're saying the Fed is and the government is just going to engage in another massive money print that's just going to inflate all assets.
I would give that something like 99% probability, yes.
So you talked about the big beautiful bill that got passed through the House and now it's in the Senate, but according to the Congressional Budget Office, it's estimated that it will add 2.3 trillion to the deficit over the next 10 years, and it's going to add somewhere between 4 to 6 trillion dollars to the debt levels over the next 10 years. And Elon, it was interesting to see Elon Musk. He recently tweeted about this, and he said that this massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. And he went on to say, shame on all those who voted for it. And once again, I guess he spent so much time trying to reduce the debt and deficit levels in the Doge program that is disgusted with what he's seen here. And we also saw a senator recently speak out. Senator Ron Johnson called it gross tech and also immoral. So he's also concerned about the massive spending that's going on and with this bill. But it sounds like you also have a lot of concerns with it.
I did my maths on it a few months ago, a month or two ago, before it went through the House. I worked out it was going to be increasing not this year, but next year, something like 500,000, and then going half a trillion. It increased the deficit by 500 billion, and the year after something like 600 million, 600 billion. So it will be a huge increase in the level of deficit.
So let's talk about the Fed now. In the last Fed meeting, Jay Powell came out and he took growth rates for the US down to 1.7% from 2.1%. He also took inflation expectations up from 2.5% to 2.8%. Once again, he was citing a lot of uncertainty associated with the trade wars and the tariffs. And at the same time, we have a Fed meeting coming up later this month, and we also have another one in July. You touched on this earlier, but the president, of course, has been trying to browbeat the Fed into cutting interest rates. And just recently, the president came out and said that the Fed should cut interest rates just on a very weak ADP number. What are your thoughts? What do you think the Fed's going to do here at the next Fed meeting in June and also in July? Do they cut rates?
I don't think they'll cut it in June. I think they probably will in July. That's my best guess on it. But if people want to see the odds, there's a website they can go to look it up and see what the probabilities are. I'll just give you the name of that. I'm just going to bring it up on my screen here. It's just go to interest rates, FGHI, and it's the CME FedWatch. If you go to the CME FedWatch, they've got it all worked out in terms of probability. They say there's what do they say? Same as me, 95.6% probability the rate will stay unchanged at the current rate, which it's 4.25 to 4.5, I think. Yeah, 4.25 to 4.5. And then
Like
if you
when
step
we
forward to July, let's just see what it says in July. Now the probability of a cut goes up to nearly just about 30%.
Clive, it sounds like you have a lot of concern about the US economy and especially the debt levels and the deficit, as many people do. But I guess one of the things that confounds me is the fact that even though we have these problems and we've had them for a long time, that this S&P just keeps going higher. It's like climbing this wall of worry. And you and I both agree in the month of April, we thought we were going to see a significant pullback, and that was going to be the beginning of a severe pullback. And yet here we are in the month of June, and the S&P's flat on the year. We have many other indices around the world. Germany's DAX index is up 20%. It's at or near all-time highs. The London's FTSE index is at or near all-time highs. It's up 8% on the year. And yet, when you see many companies that have reported their Q1 numbers, and you look at the airlines, for example, they're a good barometer of what's happening in the economy. But Delta, American, Southwest all cut guidance because of what's happening with the trade war. A number of fast food restaurants, including McDonald's and Starbucks, cut their guidance, saying people were just not coming in and spending the amount of money they were in previous quarters because of this uncertainty associated with trade wars and also the economy. The unemployment rate seems to be hanging in very well. It's hanging in around 4.1, 4.2%. But yet I see all these other indicators. Like I just saw a report on CNBC. They were talking about rentals for the summer in the Hamptons were down 30% year over year because people are very uncertain as to what's happening in the economy. So how do you explain these like conflicting views, if you will? Uh, you get you get this constant messaging that the economy is doing very poorly, but at the same time, the S&P just keeps going higher.
I'm getting a lot of messages from all over the place that things aren't going very well. In other words, we could be heading potentially into a recession. I'm hearing stories of job losses now. We here in Geneva are home to countless international organizations, and one of the members of all of these international organizations is the United States, who are cutting back on their spending where they can. So that means that people who, especially Americans who work in these international organizations, are somewhat worried. One, will they keep their jobs? And two, will their budget for spending whatever it is on humanitarian aid or education or telephone or postal, whatever the international organization is, will they keep the budget? Or are they going to have to slim down? Does it mean a reduction in bonuses? Does it mean less staff working for them? Will they have to get rid of their assistants or their secretaries? Or will they have to get rid of themselves? So there's uncertainties here. And when I look at the company results coming out, it's exactly what you say. Companies are making excuses of, we don't know where we stand. We withdraw our forecast for next year because we don't know what the tariffs are going to do to us. One day it's on, one day it's off. We're not sure which way it's going to go. You can't make a forecast. We better not make one at all. But there is another wave going on, which might potentially explain the stock market, and that is the rise of artificial intelligence. It's coming with a vengeance to businesses, and it's coming real fast, way faster than the internet arrived. Now, the fact is, artificial intelligence probably can do a certain percentage of every desk worker's job, and that's right now. So if you happen to be working at a desk and you're good at prompting, you're a prompt engineer, you can probably increase your output significantly because you're using AI if you're allowed to use it at your desk. And many firms haven't got it at the desk yet, but if you are, you're probably increasing your output a lot if you know what you're doing. There will be many people who don't increase their output because they don't master that very simple skill of prompt engineering. The result is that the offices are going to gradually divide up into two groups of people, those who are now irrelevant because a machine can do their work, and those who are mastering the machines. So the business case for replacing humans with AI is very compelling. And I'm not condoning this because I think there's got to be a social aspect here. But from a monetary aspect, if you think about it, an AI doesn't require any holidays. It doesn't need a desk. It doesn't need a cubicle. It doesn't need office space. It doesn't need a chair. It doesn't waste time going to the coffee machine to chat with its work colleagues. It doesn't take sick days. It doesn't have to go to the doctor. It doesn't even ask for pay rises. And it can do 10 times the work. It's going to work 7 days a week, 24 hours a day, 365 days a year. So replacing 10 staff with one machine can seem to make sense to many companies. Now, in many countries, they won't be able to get rid of the staff that easily because there's labor laws. Maybe in America, it's a lot easier. But in many countries, it's difficult. But nevertheless, staff do leave through natural attrition, old age, retirement, incentives will pay you off to go early, that sort of thing. So I see a world where the costs of doing business are going to come down over the next few years, and the output is going to increase. A good example of that is take a company I wouldn't buy because it's too expensive, Walmart in the United States. They've just hit all-time record profits, all-time record sales, yet their staff are something like 70,000 people less than they were a decade ago. Now, part of that's been automation. They've been replacing checkout desks, I presume, with self-checkouts and things like that. But you can imagine that's not going to stop in terms of the cost savings. The cost savings are going to come to all areas of every company. It doesn't really matter what the company's doing. It's not just people sitting at desks where the cost savings. It's going to improve logistics. It's going to reduce. AI is going to reduce accidents. It's going to redesign stores. You can't even begin to imagine the number of things that AI will be able to do very, very quickly, where you used to have people working sometimes for years to redesign something or a layout. It's all going to be very, very fast in the future. So that does mean more output and less costs. Well, what does that translate into? It translates into perhaps lower prices for the consumer too, but also more profits for the company. So perhaps these high price selling ratios we're seeing and get it and say, oh, it looks a bit expensive, the market looks expensive. Maybe it's not as expensive as we think, given the growth which is about to come.
Interesting comments. The founder and CEO of Anthropic, Dario Amodei, was recently speaking about this very point, and he said in the next 5 years, the job losses associated with AI or because of AI are going to be catastrophic. And I believe he said the unemployment rate within some groups might be anywhere from 20 to 30%. Now, that seems rather high to me, especially in such a short period of time. But nonetheless, it's going to be interesting to see what happens here in the next 5, 10, 15 years with AI and just the elimination of jobs.
One thing I'll say to your viewers, if you want to keep your job or at least improve your chances, for God's sake, learn prompt engineering. It's not difficult to learn. It probably takes about an hour. That's it. And if anybody wants to know what that's all about, I've done a paper on it. I don't charge anybody for it. It's free. They can write to me on LinkedIn and I'll send them the paper and then they can do their own work on it. It's only two, it's four sides, four sheets. So in less than an hour, if you haven't become a master at prompt engineering, there's about 30 odd things to know. You could become pretty good at it and improve your chance of keeping your job.
And there's many different AI platforms out there now. Which ones are you spending a lot of time on?
Exactly. Well, one of the important things about prompt engineering is knowing which platform to go to, depending on what task you need to do, because there's different platforms which are good at different things. So I speak personally, and this is a personal preference. If I'm writing code, like in Python, I'm going to say I started learning Python 6 or 9 months ago. I took some lessons. Um, I'm exaggerating a little bit because I quickly discovered there was no point in learning it. I just had to say to AI, write me a Space Invaders game or write me some code to see if someone's telling lies or, you just say it and it's done within minutes. Uh, so for coding, I like to use Claude Sonnet. They've just brought out version 4. I was using Claude Sonnet 3.7. When it comes to investment research, I find Grok to be very, very good at that. So I enjoy that. For a quick and easy answer, which you can't trust, ChatGPT. But it depends, if you need to trust the answer, you might want to do a bit more work on that one. If anyone wants to have a bit of fun with Grok, just ask it to, not with Grok, with ChatGPT, just ask it how many R's there are in the letter raspberry, and you'll get the answer. There's only two, as an example. Or ask it who the president of the United States is, and you'll get the answer Joe Biden. So I think that not very. I love ChatGPT for how quick and easy it is, but it's not the perfect tool for something a little bit more deep, as far as I'm concerned. When it comes to very deep and complex research, when you're looking for, let's say, a 20 or 30-page report on something very, very difficult to research. I did one yesterday. I wanted to know all the sales made by the holders of a cryptocurrency called XRP, not because I'm interested at all, but because someone had asked me. And I got a 20, 30-page report on that. That was done by Manus AI. So that's what I'd use. And
Oh, that's
obviously
one. I'm
for
not familiar with that one. I spend a lot of time on chat and also Gemini. I tend to go back and forth on those two. But you know what I'm finding is this is the new search engine. Very seldom do I look up anything on Google because it's just a total waste of time. And these are becoming the new search engine.
Well, I've using AI. I've written my own search engine in Python, so I won't use Google anymore because if I want to know something, I'll use my own search engine, which doesn't give me a long list of links. It goes and gets all the links. Then it sees which links might answer the question. Then it reads the entire web page, and then it converts it into a proper document which I can read with the answer without forcing me to go through lots of different websites, looking a bit here and a bit there, and stringing it together myself. This is the way it's going. I think the old style Google search is going to die a death. Of course, Google they do have already their new search engine. I forgot what it's called now. It's gone.
Gemini. Their
Yeah, I
AI
think it's got a
is
whole.
Gemini.
Yeah, I think so. I think are they giving it a new name or is that? Anyway, it doesn't matter. But anyway, they will. That's the way it's going to go. It's going to become more of a search engine which gives you the answer rather than a list of links. When it comes to video, there's many tools out there. But if you want to do video, Runway's a good one, and the new VO3, which is I think the Google one. I've been experimenting with that. Those are knocking my socks off.
Oh, very good. I'll
And
try.
for pictures, there's Imagen. I think that's quite a good one.
You raised an interesting point about this whole AI stuff, and one of the things is AI doesn't phone in sick or take days off, right? It's always there 24/7. And this is one of the things we've seen, especially in the post-pandemic world, is that people aren't going to work 5 days a week anymore. And so I'm based in Toronto, in downtown Toronto. There's one large office complex. It's called Brookfield Place. It's comprised of two buildings. Prior to the pandemic, 12,000 people were showing up 5 days a week. And now, after the pandemic, it's 6 to 7,000, like on a Tuesday, Wednesday, Thursday. Okay. Never mind Monday and Fridays. Okay. But Tuesday, Wednesday, Thursday, there's only 6 or 7,000 people showing up for work. Okay. So it's been cut in half. And I kind of wonder, well, first of all, companies at some point, maybe a year or 2 years down the road, they're going to say, okay, you don't want to show up for work, no problem. You're going to be replaced with this AI person. But I also wonder what the long-term ramifications are to commercial real estate and to the economy. And because you got all these office buildings, at some point, people are just going to give up their leases, or maybe they're going to take half the space that they had before. Any thoughts on that?
Well, well, absolutely. I mean, not only the offices, think about all the little businesses around these offices, the hairdressers, the supermarkets, the entertainment complexes, the restaurants, the bars, the gyms, all around the offices, there'll be all kinds of ancillary businesses which are feeding off the office workers. Now, if those office workers aren't turning up, all these businesses won't be making as much money unless they double their prices. So there may be some solutions in some places. Maybe they can start to convert some of the offices into accommodations, which would be very convenient for the people who get those accommodations if they get them, because now they'll be still near the shops and near to work if that was the case. But I think the balance of the fact is we've got too many offices now in the center of all towns, because the reality is we don't need to be working 5 days a week in the office. Now, many employers would like us to do so. There are efforts by many employers to force their employees to do that. But I think the pressure's on, and this new way of working will, in some way, shape, or form, continue with people going to the office only a few days a week, maybe 3 days a week, or 4 days a week, or 2 days a week if they're lucky, and being able to stay at home and do the work. But the real problem that's got to be worked out here is, in what way do you determine which of your employees are being productive when they're at home and which are not? And I could give you a little example of my own. When I was dealing with my father's estate, I had to upload some documents to HMRC, that's the tax authorities in the UK. And it was in the COVID pandemic, it was at the tail end of it anyway. It was after the COVID pandemic. And so these documents, I'd been trying for 3 or 4 days. They wouldn't upload, just couldn't make it work. So I finally called them up, and I got some oik on the phone. And the way he answered the phone, I already knew I was irritating him. But I later discovered he was at home. And so I explained the problem. And he said, "Oh, can you try again tomorrow?" And I said, "Well, I've been trying for 4 days. Perhaps you could put me in touch with your IT department so I can discuss the problem with them." "Oh, no, I can't do that. I'm working at home. Don't have the number." "Anyway, it wouldn't be them anyway," he says. So I hung up and I dialed the HMRC again. And then I got a person who answered and said, "Oh, yes, I'll be glad to help. Just email me the documents. I'll sort it out for you. Quick as a flash." So we have two types of people: those who are willing to do the work when they're at home, and those who see being at home as some sort of entitlement to a holiday. So how are employers, and this is the problem to be resolved, going to sort out the problem of who's working and who's not? When they were sitting in the office, the boss is at the on the table at the end of the room with an eye over all his employees, and if he sees his employees scrolling through the internet or chatting by the coffee machine, he's going to go and give them a ticking off and say, "Come on, get on with your job." But that can't happen when the guys are at home. So the bosses need to figure out how they get determine who's productive and who's not.
Well, I'm sure with AI, they can easily do that. They just got to write some sort of program.
Well,
Something,
firms have done
some
that.
program that can measure productivity.
Yeah, some firms have done that to check if the computer is moving and the screen is moving, the mouse is moving. But employees know that's happening and have figured out where you buy on the internet devices to move your mouse around when you're fast asleep.
Mhm. Okay, so you've expressed a lot of concern about the US economy and valuations in the stock market and also the bond market and where interest rates might be going. So, what advice would you give investors on where they should be allocating capital during this time of uncertainty?
Well, I've always thought that it's a good idea to be diversified, but you want to have more in some areas than other areas at certain times. Um, at the moment, I think that the gold price is very well supported, and I think it's going to continue to be very well supported by central bank buying. I think that bank buying is going to accelerate this year. I think it will probably be higher than it's ever been. And last couple of years has been very high. The reasons for that, I think, are obvious. Central banks are uncertain about where their traditional reserve asset is going, the US Treasuries. So they want something else. We might also, they've also seen the dollar, the weaponization of the dollar. And whilst they might be friendly with the United States at the moment, you don't know which way the wind is going to blow next year. I thought Canada were great friends with America until until January or February. And suddenly there seems to be a trade war going on between you two. And so what's going on? Suddenly your friends aren't your friends anymore. So I think countries around the world are starting to say we need to be more diversified, and the obvious thing to diversify into, if you're not buying as many treasuries, is gold. So I think gold price will remain very well supported. If we get a tick up in inflation, that will boost it, but that's not necessarily coming. I don't. That's not my central case. But long and short, I think the trust in the U.S. currency and other currencies is diminishing. There was a time when I was saying this, and nobody ever heard it. Banks are printing money, or central banks are printing money, and nobody ever heard it. Now I think it's being shouted from the rooftops. You have to be deaf not to realize that the money you keep in the bank is being devalued on a day by day basis. Now, that's perfectly acceptable to many people because they say, what does it matter if I'm losing in real terms 4 or 5% a year? I'm making 4 or 5% interest, I'm paying my tax, but I'm still losing money. I realize that, but I feel safe. I feel safe. Well, they feel safe now because the pace at which they're losing money is perhaps only 4 or 5% in real terms. But will they feel so safe if that rate starts to become 7 or 8 or 10? Because as the rates go higher, your buying power is going down much, much faster. So if that starts to happen, I think that there will be a shift into the gold market. But that's not my central case. I think the biggest central case is this. I think if the high-tech stocks in the United States stall, which we thought they were going to stall a month or so ago, and that could still happen. If they stall and people start to look around for something else to go into, the obvious place to go is gold, and I think many of them will choose gold mining shares. So that's a sector where I would have a little bit more weight than I've traditionally had. Other areas where I think you need to be overweight is Europe and Asia in equities. Relative to the United States, they're very cheap markets. The USA has roared ahead for years and years, outpacing the European and Asian markets big time. But that's been at the expense or caused in large part by the expansion of the price earnings ratio, whereas the price earnings ratios in Europe have hardly moved. So that means that European and Asian price earnings ratios are way below that of the USA. The dividend yields are much higher on average. So I think it's time to for those who don't have European exposure to have some European exposure. And for those who are in Europe who would have European exposure, probably just to have less US exposure, move some home. And of course, there is another factor. There's the currency factor. We've seen the US dollar index called the DXY, which is a basket of currencies against the dollar. We've seen that decline from about 108, 109 down to now 99. So that's about 9% decline in the value of the dollar over the course of this year. So even if you had a portfolio of stocks in the United States, the S&P 500, you might be flat at 0% in dollar terms. But when you measure it in euros or pounds or Swiss francs or whatever, you're down quite a few percent. So Europeans are looking at their portfolios. Yes, they're up because European stocks are up, but they're down because, unfortunately for them, their investment managers quite often had a very heavy exposure to the United States, too heavier exposure, I think. If given that the United States is something like 50% of the world markets, there was a temptation by many managers to be at that level. But even 30%, I think, for a European investor is much too much.
And when you talk about a gold weighting, you said it's higher than what you would have done historically. So what
Yeah.
would it be? 10%, 20%?
Um, yeah, so I periodically publish on LinkedIn an asset allocation table, and I never varied the percentage exposed to gold and gold miners and precious metals, which has always been 6% exposed to gold and 6% exposed to other precious metals, which specifically that's silver, really, but you could include platinum if you wanted to. And that could include the physical metal at your home. It could include gold or silver ETFs, and it could include the gold miners or silver miners. So it was 6 and 6 makes 12%. But I think that's too little now. And of course, those who had that 12% will be looking at probably more like, because the prices have risen, they've probably got more like 18% now. And I think that 18-20% is probably around the right number anyway. So next time I publish my asset allocation table, I think I will be boosting that number from 6% for each up to 9% for each.
Interesting. And what about Bitcoin?
Um, when I first published my asset allocation table, it was below 20,000. I think it was 16,000, and I put in a 2% exposure to Bitcoin at the time. And I got a lot of stick for that, especially from investment managers. And my response to them, in the politest possible way, was to say, well, Bitcoin is 16,000, it was 2,000. At what point did you decide it was a bad investment? Because that puts them a little bit on the spot because because are they going to say, well, I've always thought it was a bad investment? Well, you thought, your job is to spot trends before they happen and let your clients benefit. Of course, I never really got into such a dialogue. The second time I wrote about Bitcoin in terms of putting it in my asset allocation, I still left it at 2%, but the price was knocking on 60,000 at the time. And no, beg your pardon, I didn't leave it at 2. That was before then. I put it up to 5% at the time. And the reason I put it up to 5% was because everyone who had bought 2% now had 3 times as much, and that was now 6%. So I thought, okay, 5% gives them a little bit of room for top slicing. And again, I got a lot of stick for that. I've not changed my allocation. Well, I have actually. I haven't changed it, but in my head, I've changed it. I think people should now have about 4% Bitcoin. So
So
that would
once
mean
again,
those who've
what,
got some should be who've got more than 4% should be top slicing it.
so once again, you want to focus on scarce assets, real assets like gold, like Bitcoin, like real estate.
Yeah, I think there's a strong case for Bitcoin in terms of its utility. Uh, a lot of people have lots of ideas about the utility, but I only see one utility, and it's this. It's a belief that if you have some and the brown stuff hits the fan and you lose everything, the one thing they can't take away from you is your Bitcoin. It's in your head. It's a set of, provided you've got the 12 or 16 words that you need to get back your private keys. It doesn't matter where you are on the planet. If they suddenly decide that you're a friend of some oligarch and therefore your accounts have to be frozen, they can freeze your accounts. They can take your yachts, but they can't take your Bitcoin, which means that you can fly to Dubai where there's no sanctions and unlock it and spend it. If you happen to be a businessman with a huge business empire which might go crumbling under, you know that if it goes down, they're going to come for you. They're going to come for you big time, and they're going to take what you've got. but they can't get you Bitcoin. These people, none of them care whether the price of Bitcoin goes up or down. Of course, they'd like it to go up, but they don't care. What they care about is if the worst comes to the worst, will it still be there? And it's been around for 17 years. And I think there's a general belief that it will still be around 17 years from now.
Well, Clive, that was a great discussion, and I want to thank you very much for spending time with us today and sharing your thoughts on where you think the economy is going and how to navigate it. If somebody would like to follow you online, where can they go?
I write articles once or twice a week on LinkedIn. You can look my name up. If you put in Clive Thompson's retired wealth manager, Switzerland, it'll almost certainly come up. If you don't find me that way, I look out for that. You'll probably find an article by me if you look for something related to investments. I'm on YouTube as well. I've got a channel. It's called Clive Thompson. There's some funny letters after my name. You're welcome to go there. I've been running the channel now for a month. I've done about 4 or 5 videos. You might like to see what they're all about, but basically they're about investing in stocks and teaching people how to make money.
Very good. I will make sure I subscribe. Clive, once again, thank you.
Thank you very much, James. Nice to and thumbs up from all your viewers.